Hello friends, hope you're doing well. Chris Lee, CPA here, back with another video for you. And today we are going to talk about 5 common myths regarding the sale of your principal residence and the related tax exclusion as it relates to any gain that could result from that transaction. So when you sell your principal residence, a lot of people are kind of familiar with the idea that it's a potentially non-taxable event, but there are some misconceptions around it and some ideas that come up that maybe aren't, so true. So today we're going to talk a little bit about the, some of these myths and what the code and regs and IRS guidance tells us how these should be treated as. So the first is that you have to have 2 years, that the 2 years of use of a home must be consecutive. So in general, we'll kind of step back for a second and say that to claim an exclusion on your property, you have to meet what's referred to as an ownership test and use test. So in the last 2 of the 5 years, you need to, during a 5-year look back period, you need to use the property as your principal residence and you need to own the home. So those are kind of the 2 requirements. Now, one common myth is that the 2 years use of the home must be consecutive. That is, you live in the home continuously for 2 full years without any breaks, and that any single interruption may void that exclusion. This isn't true. So the fact is that tax code allows us to aggregate 2 years, aggregate up, through the years in the 5-year look back period to get to that 2-year period. So this is to say that periods don't need to be consecutive, and short-term absences, sabbaticals, temporary leave of the property isn't going to they're not going to count towards the 24 months of meeting that use requirement of the property, right? You have to have both ownership and use of the property. The ownership and use don't have to overlap, but you do have to meet both of them. You have to aggregate and meet the 24-month rule and aggregate both. They don't have to be continuous and at the same time, but you do have to meet them both separately, the ownership of the property and use of the property. When I say that the ownership of the property doesn't necessarily have to overlap with the use of the property, this is to say you could have a property that you actually rented and then you decided, hey, I'm going to purchase this property as my principal residence. You go ahead and purchase the property. You've had use of the property as a principal residence. You rented it and used it as your primary residence before you owned the property. Well, when we look at the sale of the principal residence, exclusion, we can actually count that period where we rented it towards our exclusion, but maybe not. But that didn't necessarily overlap with the ownership. So that is to say, you could have moved out of the property, bought a new property, and had that sitting on the market. You meet the 2-year ownership requirement, maybe just by virtue of that property sitting on the market, waiting, to be sold. But the use of the property you did very clearly meet, maybe because of that rental period being included with the use as a principal residence. And so the ownership and use test don't have to overlap, but then also that is to say the use of the property doesn't need to be consecutive either. You can have different blocks of periods where you do use the home as your principal resident and still be able to claim that principal residence exclusion. So that principal residence exclusion, just to clarify too, is $250,000 if you're filing single, and $500,000 if it's a married filing joint return. So myth number 2, married couples always get the full $500,000 exclusion. So that's to say, filing jointly will automatically entitle a married couple to exclude $500,000 of gain. No conditions are required. Obviously, when we say anything as an absolute in tax, that is probably not correct. So the reality is that $500,000 exclusion requires at least one spouse of the married couple to meet the ownership test, and that both spouses meet the use test separately and independently. They might have overlapped in periods, but they both have to meet it. And so if only one spouse satisfies both tests, then the couple is going to only get the $250,000 exclusion. So the exclusion is reduced if either spouse used it, within the prior years or what have you. So it used the exclusion in the prior years as well. So that's kind of what you see there. So when you use the when you use the principal sale exclusion, you can only use it, a certain number of times within the last 5-year period. So that's myth number 2. Myth number 3, all gain on a former rental can be excluded once you move back in for 2 years. So say you had a property that was a rental, and then your tenants left and you decided, hey, I'll move back in, make it my primary residence. And so I can, convert this property back to principal residence, personal use, and get that gain exclusion. So that is to say, this myth is if you convert a rental to your primary residence and live in it for 2 years, you wipe out any taxable gain, including all the rent period appreciation. The reality is there are 2 different rules that are going to kind of have a problem for you here. So one of them is depreciation recapture. Any depreciation claimed on the property is going to never be excluded. It's going to come back. So you took a deduction for the depreciation of the property as kind of a business expense to offset rental income. Anytime you take a deduction for depreciation, it comes back as a recaptured item, and it's taxed up to 25%. And this is regardless, because you took a deduction against the property. When you exit that property from a sales transaction, you're going to report that kind of the depreciation, the deduction to previously as income. That's the concept of recapture and tax. So that's always going to be taxed. Then there's a second rule that you have to worry about, and this is called the non-qualified use ratio. And this is where we say gain allocable to periods of non-qualified use, rental or investment use, that precedes the principal residence use. So that is to say, if you have a property that before it became your principal residence, it was some sort of business use or rental use, investment use, that period is not eligible for the Section 121 exclusion, so appreciation related to that period. And you basically are going to calculate a ratio that reduces your overall available exclusion. So your upper limit of like $250,000 or $500,000 gets reduced. So that's not to say all of your gain becomes taxable, because that might not be what the gain on the transaction is. However, your limit, the ceiling of what is excludable, reduces if you've got rental use that precedes the principal residence use. And so you've got 2 issues. Like I said, the depreciation recapture from that investment use or rental use always comes back as income, and it's taxed up to 25% regardless. And then that non-qualified use ratio is a problem, and that is, rental use or investment use that precedes it being principal residence use. It reduces your ceiling, that $250,000 limit for singles and that $500,000 for married planning jointly. So it reduces that ceiling and gives you more exposure to a taxable gain. All right, so myth number 4, if you don't meet the 2-year rule, you get 0 exclusion. So say you fail to satisfy the full ownership or use test, you owe tax on every dollar. Well, that's a myth. You can get a partial exclusion when the primary reason for sale is a change in place of employment, health, or some unforeseen, circumstances. The reduced threshold, has this kind of specific ratio. It's basically, it provides a safe harbor that, if you've got a new job that's at least 50 miles away, that you can, reduce your exclusion and whatnot. This is provided by the IRS to say what allows you to take this reduced exclusion. And again, this reduced exclusion is to say that your limit goes down. Most of the time when you hold a piece of property for a short period of time, you're oftentimes not going to see such a large appreciation of the property that you're going to be above those limits anyway. So if you don't meet that kind of like 2-year requirement, now this is also to say that maybe you had the property as your principal residence, you moved out, then you had it as a rental, and then you sold it later, and you didn't quite meet that exclusion period, and you moved due to some safe harbor reason that exists, like a job that is 50 miles further away from your home than what you had originally. that exclusion is going to be reduced. All right. So the last one is you never have to report the sale if the gain is under the exclusion limit. Well, that's not correct. So you must report the sale. Um, you really should report it at any time that the transaction occurs, but especially if you receive a 1099-S, which is to say the proceeds that occurred from the transaction. So, and then that is also if any portion of the transaction is taxable, you need to report that as well. So even if it's fully excludable, you need to disclose it when you receive the 1099-S. And for my clients, honestly, regardless of receiving a 1099 form that says what the proceeds from the transaction were, I go ahead and report it. And the reason is that it can actually, so even if there's no taxable income, your tax return statute of limitations can remain open longer than you think because you didn't report the proceeds. So statute of limitations is oftentimes related to the how much you've understated income. Well, if you don't support your if the IRS kind of only assumes and knows that you've got a certain amount of income that came on as a taxable gain, right, via this 1099-S, and you don't report any offset to that, like what you paid for asset, the basis, this principal amount that gets reported to the IRS can exceed the 25% threshold that relates to understating your income, that allows the tax return to stay open for, potentially up to 6 years or even longer or indefinitely. And so even if the transaction itself isn't your exposure, it leaves the statute of limitations open for some other thing that could have happened during the tax year unexpectedly. So all of this to say, these are some common myths that can be seen, can be that you can find online that are kind of incorrectly understood. And so we've got the so non-consecutive use of the property still counts. So just remember, non-consecutive use of the property still counts. You don't automatically get the $500,000 cap. Both in a married filing jointly couple, both spouses must meet the use test. One spouse needs to meet the ownership test. The reason the use test isn't required is because for certain reasons people could avoid putting assets into the names jointly, or you could have had a couple that made an abode together prior to being married, those sorts of things, and they didn't quite own the property together. So all of that is to say there are reasons that you could have not have an ownership together, but you do meet the use test. Rental conversion does always result in some amount of tax. So first, the depreciation recapture, that is always going to come back as a tax. And the second item is that if you have a rental property, if you have a property that is a rental before it becomes a principal residence, your cap on what is excludable gets reduced. So that's your non-qualified use ratio. So you have to be mindful of that when it comes to calculating your threshold for what is excludable. So next, partial exclusions do exist. Just remember that partial exclusions can exist, and oftentimes it's related to health or your job, relocation, or something like that, and it reduces again the available exclusion to you. And you're still required to report. So particularly if you receive a 1099, reporting the sale proceeds. So keep those things in mind as you're working through it. If you want to have a direct consult related to something, with the principal residence sale exclusion, feel free to book some time below and we can get into it. So appreciate your guys' time. Back in another video for you soon. Take care.